If you only looked at price, last Friday looked like chaos. Bitcoin plunged, Ethereum followed, altcoins imploded, and by the time most of the market woke up, the tape had already started crawling back. But look closer, and something doesn't sit right. Minutes before the first red candle hit, a handful of wallets opened massive short positions, hundreds of millions in notional size, perfectly timed with the policy shock that followed. 30 minutes later, Donald Trump's team dropped the news, a 100% tariff threat on Chinese tech exports. The market tanked instantly. By the time the liquidation cascade finished, nearly $19 billion in leveraged positions had been wiped out. Somebody knew something, or at least that's what half of crypto Twitter believes. The other half says it was simply hedging, smart algorithms reacting to sentiment signals before humans caught up. Either way, the timing was surgical. And that's why the story still won't die. Here's what we actually know. On Friday afternoon, US time, a handful of exchanges saw an abnormal surge in open interest on the short side for both Bitcoin and Ethereum. Most of it concentrated in perpetual swaps with unusually tight stop distances, a sign of high conviction short-term bets. Roughly half an hour later, the tariff headline hit the wires. It landed into one of the thinnest liquidity windows of the week. Late Friday, when market makers are running light books and risk teams have already started their weekend rotations. It was the perfect storm. Within minutes, Bitcoin slipped from 120,000 down to 105. Ethereum lost more than 12% in the same span. Exchanges started cascading liquidations, feeding on their own price data, and a chain reaction rippled through derivatives desks around the world. On paper, it looked like a flash crash. In reality, it was a system flush, and whoever was short walked away with generational profits. On-chain analysts quickly started mapping the wallets. They found two in particular that stood out. Both opened large short positions less than 30 minutes before the news, then closed within hours of the sell-off, realizing what appeared to be 8- and 9-figure gains. One report claimed over $160 million in profit. Another rumor went further, alleging a $700 million notional short position that netted over $200 million in less than a day. None of it has been officially confirmed, but the timing alone was enough to light up every feed in the space. The question is whether that kind of trade was luck or information. Could someone have known the tariff threat was coming? That kind of leak isn't unheard of in traditional markets. Currency desks, commodities traders, even bond dealers have occasionally acted on early policy drafts or embassy whispers. But in crypto, where regulation still lags, proving that someone traded on non-public information is far harder. That hasn't stopped the speculation. Some point to large macro funds with automated hedging models that constantly monitor political language across news feeds. Those systems look for patterns, changes in tone, phrasing, or the frequency of certain keywords like tariff, sanction, or ban. When that model detects a spike, it can automatically open protection trades, including crypto shorts, in under a second. It's entirely possible one of those models simply fired early. But the scale of the trades has raised eyebrows. A hedge might protect tens of millions in exposure, not hundreds. These were whales moving with conviction, and they were early. To the community, it feels too clean. The market hadn't even flinched yet when those shorts went live. That's why the term dodgy dealings started trending. Because in crypto, coincidences that profitable rarely stay coincidences for long. Exchanges, of course, denied any leaks. Binance released a statement saying the trades came from normal market activity, and Bybit's risk team claimed no internal or external communications were shared. Yet within hours, on-chain sleuths had linked the suspicious wallet activity to a cluster of addresses historically tied to a single market-making firm. That firm operates both on-exchange and over-the-counter, giving it an unusually clear view of liquidity. The speculation grew. Maybe it wasn't government information at all. Maybe it was order flow intelligence, or advanced knowledge of a large fund about to de-risk ahead of macro uncertainty. Whatever it was, the optics are terrible. Every time crypto feels like it's finally cleaning up its reputation, something like this happens and pulls it straight back into the shadows. To an outsider, it looks like another insider job, another example of whales playing chess while everyone else is playing checkers. And perception, in a market built on confidence can be as damaging as proof. Quick reminder, if you're trading size or holding long-term, protect your stack with a ledger wallet. Keep your keys offline, your coins under your control, and your peace of mind intact. You can grab one through the link in the description. So how plausible is insider trading here? In US terms, the concept hinges on material non-public information. That means trading on knowledge that isn't public yet, but would impact price once it is. In equities, that's crystal clear: earnings, mergers, policy moves. In crypto, it's murkier. Bitcoin and Ethereum are classified as commodities under the CFTC, not securities, so the SEC's usual insider trading rulebook doesn't directly apply. But the CFTC still prohibits fraud and manipulation, and that umbrella includes trading on leaked policy information if it crosses US jurisdiction. If a trader received word of the tariff draft before it was public, and used that to open shorts, that would qualify as manipulation or misuse of non-public information. The challenge is proof. You'd need communications logs, timestamps, and exchange cooperation showing that the positions were placed before any version of the news hit public data feeds. So far, there's none of that. Only circumstantial evidence. But the window between the trades and the headline, roughly half an hour, is close enough to trigger scrutiny. It's also worth noting that regulators are paying attention. The SEC's Enforcement Division and the CFTC's Market Oversight teams have both confirmed, unofficially, that they're reviewing large derivatives transactions around that time frame. They've requested data from several major exchanges, including Binance, OKX, and CME's crypto products, focusing on any abnormal short positioning immediately before the announcement. Whether that leads to charges or not, it sends a message. Even offshore trades are no longer invisible. While those investigations unfold, it's helpful to look at the market mechanics that amplified this event. Leverage was sky-high before the drop, the highest perpetual funding levels since early 2024. Analysts at CoinShares noted that funding rates swung from plus 0.03% to minus 0.01% in under an hour, the sharpest reversal in 18 months. Traders were leaning long, chasing the breakout above 120,000 on Bitcoin and 4,200 on Ethereum. When the tariff news hit, that leverage flipped against them instantly. Liquidation engines don't care about intent, they just unwind positions. That's how a single headline turned into a $19 billion flush. Once the first billion in longs were closed, the collateral fell, triggering the next wave and the next. Each liquidation lowers the price, which triggers more liquidations. A mechanical avalanche. You can almost picture it. The screen flashes red, volumes explode, and every algorithm starts chasing itself downhill. To make things worse, a few exchanges reportedly had price feed issues right in the middle of the chaos. Binance's perpetual index momentarily diverged from spot by more than 2%, which doesn't sound like much, but is enough to liquidate over-leveraged traders instantly. Bybit's Oracle feed also lagged during the heaviest volume. If those glitches hit at the same moment as the macro shock, it would have magnified the wipeout. Afterward, as prices stabilized, analysts called the sell-off both inevitable and suspect. Inevitable because leverage always unwinds this way eventually. Suspect because the catalyst felt too perfectly timed. And that's the uncomfortable truth. Both can be true at once. A market can be mechanically fragile and exploited by someone who knew when it would break. In the aftermath, Bitcoin and Ethereum rebounded, but the trust deficit remains. Traders are now calling for transparent pre-event auditing, independent monitoring of large derivatives builds before major policy announcements. It's unlikely to happen anytime soon, but the conversation is important. Transparency is the only antidote to conspiracy. From an investor's point of view, this event reinforces two lessons. First, macro always trumps micro. You can have perfect on-chain analysis, perfect technical setups, and it can all vanish in a minute if geopolitics intervenes. Second, if something seems too calm before a major announcement, it probably is. When funding rates stay positive into risk events, it's a warning, not comfort. There's also a psychological layer. Retail traders tend to assume manipulation when they lose, but there's a middle ground between conspiracy and coincidence. Markets are full of professionals whose entire job is to anticipate, not predict, and sometimes they just get it right. Still, transparency gaps in crypto make it too easy for fair trades and foul ones to look identical. That's why regulation, the kind that enforces disclosure without killing innovation, matters more than ever. Over the next few weeks, expect agencies to keep digging. If subpoenas reveal coordination between policy insiders and traders, it'll be one of the biggest scandals in crypto history, bigger than FTX, because it would cross into national governance. If they find nothing, it'll still reshape the narrative. Exchanges will strengthen surveillance, desks will tighten compliance, and every trader will think twice before putting on oversized positions ahead of political events. The irony here is that scandals like this often make markets healthier. They force better risk controls, stricter transparency, and cleaner data. Each time the system breaks, it rebuilds with thicker skin. You can already see that process happening. Liquidations are clearing faster, circuit breakers are kicking in earlier, and insurance funds are handling the stress without collapse. That's maturity. Meanwhile, politics has fully entered the crypto narrative. Farage's pro-crypto stance in London, Trump's tariff threats in Washington. These are two sides of the same coin. One is courting digital assets for growth. The other is punishing trade for power. Both show that crypto is now woven into global economics. It's not just a speculative corner anymore. It's policy-sensitive capital. And that's what makes episodes like this so dangerous and so fascinating. For traders, the playbook going forward is simple. Respect leverage, respect timing, and don't underestimate the speed at which macro can rewrite every assumption. Protect your stack, diversify custody, and if something feels engineered, step aside. The market will always give you another entry, but it won't give you another bankroll. For long-term investors, focus on the fundamentals that didn't break. Bitcoin's network never paused. Ethereum's validators never went offline. DeFi kept clearing. NFT markets kept minting. And cross-border payments didn't skip a block. The infrastructure held, the humans panicked. That's worth remembering. So, did someone inside Washington leak the tariff decision to a trader? Maybe. Did someone on a hedge desk connect the dots faster than everyone else? Definitely. Will regulators find a smoking gun? Possibly not. But the point isn't to prove guilt. It's to understand how fragile trust still is in a system built on transparency. If crypto wants to be taken seriously as the future of finance, it has to learn to handle moments like this in daylight, not darkness. That means traceable market data, verified audit trails, and cooperation between regulators and exchanges without killing the speed that makes this market what it is. Until then, these dodgy dealings will keep haunting every correction. Every crash will have a villain, every rebound a conspiracy. But here's the truth. The real edge isn't inside information, it's discipline. The people who survived that $19 billion wipeout weren't lucky. They were prepared. So as you listen to this, remember, markets are fairer than they look, but crueler than they seem. Timing beats outrage, information beats emotion, and survival beats everything. Drop your thoughts, follow the show, and as always, we'll see you at the top.